Welcome to an introduction to accounting. This podcast was prepared by Parkbench Tutors. I am going to demonstrate the construction of a cash flow statement using the example from the text. My aim is to show you where to look on the balance sheet, income statement and notes to accounts so that you can extract information for your statement. We will use the income statement, which gives us figures relating to profit, expenses, interest and dividends. We will also use the balance sheet and extract information relating to assets, liabilities, and, in this example, a note to the accounts relating to purchase of an asset. The cash flow statement tells us about the inflows and outflows of cash during the accounting period. We start with looking at inflows and outflows from operating activities. So the first figure we are looking for is the net profit after interest but before taxation. Which financial statement will provide us with this figure? The figure is obtained from the income statement. I have highlighted the line here to make it easier for you to follow what is being done. The figure is 193 million. This becomes the first figure that we enter onto the cash flow statement. The next step we will take is to add back in any depreciation. Sometimes you will find this figure is given as part of the income statement. Here it is not shown there, so how can we find the depreciation for the year? Depreciation relates to non-current assets, so we will look at changes for the year. Land and buildings are unchanged, but in the notes I see machinery was purchased, so I look at plant and machinery and see a change. The figure at the start of the year will give me the value before any depreciation. Here are the figures we are going to use for our calculation. We have figures that relate to the start of the accounting period, the end of the accounting period, and a relevant transaction relating to a non-current asset that occurred during the period. This is how the calculation is carried out. Starting with the figure for plant and machinery at the start of the year, 309 million, the cost of the machinery purchased is added. Then the figure for plant and machinery at the end is subtracted. The difference gives me the depreciation of 79 million. Can you see that assets at the start plus assets bought minus depreciation equals assets at end? We will now enter this amount into the cash flow statement. Right, what is next? Now we need to remove income from investments and to add back in the interest expense. We shall find both of these figures on the income statement. Interest received comes to a figure of 17 million. Interest payable comes to a figure of 23 million. Let us put these figures into the cash flow statement. Here we are. We subtract the figure of 17 million that was received as an investment and add back in the interest expense. Now we look for changes in trade receivables, trade payables and inventory. We shall find all of these figures on the balance sheet. But remember, we need the balance sheet figures from the previous year as well. We're talking change here, so we need a starting and ending, or an opening and closing figure. The figures have been highlighted on the balance sheet: inventories, trade receivables, and trade payables. Trade receivables has a change of 18 million. It has increased, so we need to subtract that figure. Why? Because we have not received the cash for those sales. Trade payables has decreased by 1 million. That is 1 million less as cash over the year because we have made the payments. So we're going to subtract that amount as well. Inventories have decreased by 3 million. We can say that these have been turned to cash as a result of the sale of inventories. So we need to add back in this 3 million. These figures are now entered onto the cash flow statement. Subtract 18 million for trade receivables, subtract 1 million for trade payables, add 3 million for inventories. One note here, normally we would place parentheses around figures we subtract. I've just used the minus sign to make it clearer. I now have a figure for the cash generated from operations. In other words, I think I've identified all the inflows. But I still need to make some adjustments. I need to remove some outflows that were not related to operating activities. Interest paid, taxes paid, and dividends paid have all to be removed. The interest paid, 23 million, is located on the income statement. I now enter this to the cash flow statement. The corporation tax is not as easy. Remember that 50% is paid in the following year, so I also need to pick up a figure from the previous year. The figures are available from the balance sheet. I have 16 million as a liability from last year that must have been paid this year. I also have a liability of 23 million for this year, so this represents 50% I am carrying forward. That means I must have paid the other 50% or 23 million. I can enter these to the cash flow statement. 16 plus 23 gives me a figure of 39 million. Lastly, dividends, which I will find on the income statement. The figure is identified here. A dividend of 50 million was paid, which has been entered to the cash flow statement. We now have all the information to determine the figure for net cash from operating activities. The net cash flow from operating activities is 150 million. We turn next to the investing activities. Did we purchase any non-current assets? Land, machinery, shares in another business, patents or other intangibles? We can identify one purchase, machinery, which represents an outflow of cash. We can also find an inflow. Interest was received from investments. The figure for the asset purchase is a note to the balance sheet. A figure of 95 million for machinery purchased. The figure for interest received is on the income statement. A figure of 17 million. The result is a net outflow of cash from investing activities of 78 million. The last part is to look at the financing activities. On the balance sheet, I can see the information that relates to repayment of debentures. A sum of 150 million was paid. To look at inflows, we look at equity, which tells us that shares were issued. Ordinary share capital increased by 50 million, and share premium by 40 million. The entity raised 90 million through share issues. These figures for debenture loans, ordinary share capital, and share premium have been highlighted on the balance sheet. They have been entered to the cash flow statement. The result is a net outflow of cash of 60 million. We can now complete our cash flow statement. Operating activities gave an inflow of 150 million, investing an outflow of 78 million, financing an outflow of 60 million. There was a net inflow of 150 minus 78 minus 60, which is 12 million. You will have noticed that at the bottom there were figures for a neat little reconciliation. An overdraft at the start of the year has been reduced by 12 million, which agrees with the cash flow statement. You can also see how much more information this statement has yielded. Without the statement, all that we really had was that an overdraft had been reduced by 12 million, representing a net inflow of cash to the entity. This ends the podcast, showing an example of how a cash flow statement was constructed for this business. Remember, the procedures will be the same for all other entities, but not the figures. Thank you for watching and for listening. This was brought to you by Parkbench Tutors, narrated by David Hopcroft. For more information about Parkbench Tutors, please visit parkbenchtutors.com.